Greetings, Jonathan. Camarda, as we enter into the final month of the year. And what a November to remember, right? As we mentioned when we were going through the downturn of August through October, those first 2 days of November, last 2 days of October, that seasonal switch, well, it went on extra bright. Like all the lights I got illuminating this huge room that I'm in right now. And so what does that mean now? Well, little tease. Let's start off with what we've done. So great month, pretty much across the board. We had the 10-year yield coming down. It's at about 4.2 and change now, coming closer to that 4% range from 5, right? So what does that mean, right? Rates have come down. Dollars come down versus euro, yen, Canadian dollar, CAD there across the board that we watch. We've had, again, the American Association of Active Managers, of course, picking up their equity exposure, risk assets over 80%. Again, we were, more persistent even during that latter portion of the downturn, ahead of the curve there because knowing that seasonal pattern. Weak dollar, lower rates. Bonds had a great month, right? The 20-year. So you would have known or a few weeks ago rather, on even the more conservative strategy, active capital preservation, where we added more fixed income exposure, reduced our 20-year short, long interest rate exposure with just a little bit left there. We'll get to interest rates here in a minute as far as where we're looking from here. That inversion, a little less pronounced, right? Those shorter term yields where it was really like an upside down seesaw have leveled off a little bit. And of course, that's given that energy pocket for equities and bonds. Strongest sectors for the month. Well, again, the usual culprits, technology, discretionaries, but in a close third, financials. And with rates coming down, gave a little bit of oxygen there to the financials. Energy was the only sector not up last month. Again, so where do we look at things? Couple things we're observing here on a longer term. Emerging markets on a relative value versus U.S. stocks, okay, as we talk about currencies and the such there, at 20-year lows. Does that present an immediate opportunity? Probably not. That's such a mercurial asset class, emerging markets. So many things, the global macro, currencies, interest rates, like a sailboat in the middle of the ocean are emerging markets. You just don't know which way it's going to blow. However, maybe opportunities that we're always, looking at there as well. Just an observation. Now, as far as equities going forward, generally you wonder after a November like that, all that running, out of breath, what does the market need to do? Well, historically, December, 70% of the time is up, generally about 1.5%. Santa Claus rally usually doesn't happen towards the latter portion of the month, and the real energy doesn't start to pick up till mid-month. So expecting a consolidation, perhaps a little digestion of November's gains. Could see some red here early in the month, no pun intended, before the green. I had to throw it in there. And that's generally what you're looking at. Now, historically, after a month we've had in November, the following month, generally in the green, and the ensuing months well into the green. No promises. Pre-election year, see how that playbook goes along as far as markets, as well as, again, when we start to look at fiscal policy and the Fed. Everyone thinks the Fed's out of the picture, and they're already looking at rate cuts. Well, probably not till beyond second quarter of next year. We'll see. As I think, they talked about higher for longer. It may just be high for longer. So what's the bifurcation there, Jonathan? What are you talking about it? As far as break down the granularity here. Well, high means they may not do anything. They're not going to lift rates, but they're not going to reduce rates. So as opposed to higher, keep raising them. They'll just kind of keep them level. Let the medication work through the patient, the U.S. economy, and really the international economy for that matter, as we'll see what the ECB does here as well. So with that being said, to kind of put a bow on it, from that standpoint, allocation-wise, again, risk assets have been increased, slightly. Again, we remain diligent even during that down pocket there, knowing the seasonal patterns as up through July, the way the market was, pull back August to October, and then a resurgence during a seasonally strong time of year, November through the end of the year. Really, November through May historically has been the most attractive time to be invested. Again, we'll remain eternally vigilant to see again, if rates continue, again, we're starting to see a little bit of a tug of war as 20-year treasuries are up against resistance here. Will rates continue to drop like they did in November, or will there be a little bit of a tug of war here? So we have to remain diligent there, what that means for risk assets, taking nothing for granted, from that standpoint. So if you have any questions on how this affects your individual risk tolerance or the idiosyncrasies, easy for this guy to say, of your actual portfolio and your risk tolerance situation versus what the models are actually applying on a day-to-day basis. Certainly talk to your personal wealth advisor to make sure that we got that blueprint, that fingerprint exactly where it needs to be for you, which is what's important. From a global macro basis, though, again, still more optimism, a little bit of caution, tapping into the brake pedal after that hard, nice turn here around the track that the market's taken as we just kind of gather ourselves. So again, stocks, bonds been attractive for November. Bonds hitting a little bit of a headwinds here. It'll be a seminal moment to see if they can break through and rates give way, or if there's a little bit of that, pulling on the rope there above the with that muddled middle. Equities again with some of the leading sectors continue to be strong that we've seen all year, which generally historically makes sense. That being said, stay warm, stay cool, whatever the weather throws us here in Florida. Enjoy family and such, and we'll talk to you tiptoeing around Santa Claus coming down that chimney. Till next time, Jonathan Camarda, and as always, just like the snowman, stay frosty.